Good morning, everybody. Thank you for joining us this Tuesday. So glad that you're here. I want to make sure that our slides are working today. All right. Great. Okay. So thanks once again. Thanks for joining us. This is once again another great webinar from our 22 Secrets of Successful Retirement series. Today, our topic is income changes everything. And this one is a real important one for us as a business and just for those and our clients around us. We really do see the impact of income in retirement and how important it is, regardless of how you're invested in different things. If you've got income to live on, you live a more secure retirement. Now, at Senior Resource Center, we help in 4 different ways. We do comprehensive retirement planning. We do tax planning to help people pay less tax. We don't do tax prep, but we do help people find ways to pay less tax over time. We do a lot of long-term care planning, and that includes insurance products as well as helping people qualify for federal and state programs and helping them protect their assets to get those. And then finally, estate planning, which allows people to, have their wishes met, whether it's during their lifetime or after. All right, so again, this is part of a 15-part series that we're doing over the course of this spring. We started back in February, and if any of these topics you haven't been able to attend, but they're interest to you, you can always go on our website, srctexas.com, and go under resources. We have all these webinar recordings from this year, as well as our series that we did in 2021. So today, of course, is Income Changes Everything. And then next week, we'll be talking about ways that people under 60 can look at their investment profile and how they can make smart choices going into their retirement. All right, so that being said, I'm going to pass it off to my business partner and author of Secrets of Successful Retirement, Bill Witt.
Thanks, Tara. Hey, welcome everybody. Glad you joined us today. This is probably my favorite webinar of all the webinars we give because the topic we're going to talk about today is the bedrock of our practice, and that is the importance of income in retirement. Let me start with a disclaimer. We're going to go through some case studies. We're going to talk about a number of topics. Everyone's financial situation is unique, and so the actual results that you get from case studies vary based on what you do. And historical performance is no guarantee of future performance. Also, Tara and I are not securities licensed. We may touch on some topics that deal with securities, and if we do, these are just opinions. Always refer questions like that to a licensed financial professional. So, what is the challenge that we face today? If you've received a copy of my book, or if you've read a copy of my book, you know that I talk about longevity, and the reality is we're living a lot longer. If you go back the history of mankind, going back to the Stone Age, and Google, how long did the average person live in the Stone Age, maybe in Roman times, medieval times, or even in 1900, the average life expectancy was somewhere around 30 years. Well, if you do it today, if you're born today, the average life expectancy in the United States is 78 years. So in the last 120 years, longevity has become a significant issue. And what that means is the idea of working 30 or 40 years and then retiring for 3 or 4 years is no longer reality. We work for 30 or 40 years, and then many of us will be in retirement for 30 years. So our money must last longer and avoid a gauntlet of risks. If you're 65 today and you do the research on this, you find that men on average live an additional 18 years, or the average life expectancy would be to age 83. What if you're a female today, you're age 65? Your life expectancy is another 20 years. But these are average numbers. And if you watch your health and watch what you eat and watch your weight, visit the doctor on a regular basis, with modern medicine, fully half of the people in our society will live longer than this, well into their late 80s, 90s. Many of us will live to 100. So longevity is a growing challenge. And the other issue that we face is that uh, the problem is that there's many risks that we can encounter along the road of retirement. I call it kind of a financial marathon. If you're going to be in retirement for 20 or 30 years, your your funds, your resources, your savings are exposed to a litany of risks like stock market corrections, potential overspending, taxes, inflation, medical expenses, long-term care expenses. That's a huge one. Scams. There's everybody and their brothers out there trying to scam us out of our money. We face the challenge of incapacity, living beyond when we can make our own decisions, and then a litany of creditors and lawsuits. So think of this as kind of running a marathon in retirement. And not only does our money have to last longer, but it has to avoid all of these risks. So, what are the topics we want to talk about today? First, I'd like to define the financial landscape that we kind of operate in. I want to talk very briefly on the type of advisors that are out there and the financial advice that they're offering. Then I want to kind of do a deja vu, go back and talk about a period in our history where retirement planning was quite different. I call it the Camelot period. Uh, I'm going to present some research that talks about the impact of income on retirement planning. And then we'll talk about two different strategies: ways to maximize Social Security income and ways to create additional income in retirement. If you look at the financial planner or advisor landscape, there's two types of advisors. And I would say the majority of advisors today are on the left side of the screen. They are people that are recommending and proposing and trying to assist you in doing what's known as asset growth. That's where you invest in the stock market or in real estate and you want to grow your value over time. There's nothing wrong with that, except that asset growth is something that to some extent is outside of our control. You and I don't control what the stock market does. We don't control what the Fed does with interest rates. So, asset growth, and this has been pretty much the landscape of retirement planning since the early 80s. It's been based on the theme of asset growth. Well, the original proponents of some of the strategies today, most people have what when they retire? They have a 401k or an IRA. And, the original proponents of 401ks have since kind of critiqued their own recommendations. If you read my book and read the preface, you'll realize that the people that actually were the original proponents of 401ks now realize that what that really did was expose retirees to market risk and also to Wall Street making huge fees. So uh, we've been told that you can invest in investments and start drawing 4% of your value over your lifetime and increase that amount 4% of the savings based on inflation, and you'll never run out of money. But then 2000 showed up, and the markets took a heck of a wallop in the dot-com meltdown. And then in 2008, we had another round of market collapse based on real estate, the mortgage-backed securities. And many of the original proponents of 401ks as a way of building a safe, secure retirement kind of stood back and said, this model has flaws in it. Well, about that same time, a handful of advisors started investigating the role that guaranteed income has in retirement planning. And Tara and I are on the right side of the page. We believe in having enough guaranteed income in retirement to support your lifestyle. If you have that, you don't worry about what comes next. So, what did our grandparents have in retirement planning that we don't have today? If you go back to the 1950s, 60s, 1970s, you'll find that the landscape then was very different from the retirement landscape today. And income played a much bigger role in retirement. So, what did our grandparents have in the 50s, 60s, and 70s? They had tax-free Social Security income. That's how President Roosevelt defined it in the 30s during the Great Depression. They created Social Security as an income source to support retirement. They wanted people to live comfortably in retirement, and all of that income was tax-free. At the same time, what did companies offer? Companies were looking for ways to attract and retain employees, and they began to offer lifetime pensions. You work for a company for 20 or 30 or 40 years, you retire, and they give you not a bucket of money, but they give you a lifetime pension that will support and sustain your lifestyle in retirement. Well, what happened? Starting around 1980, two things happened. First, President Reagan realized Social Security was underfunded. So he allowed Social Security income to be taxed. And in the early days, they only allowed 50% of your Social Security income to be taxed. But President Clinton upped that to 85%. So today, the promise of tax-free Social Security income is long gone. Today, our Social Security income is taxable for many people. Second, what happened with those pensions? Remember the pensions that companies offered? Well, starting in around 1980, companies started to realize they had pension obligations. With longevity increasing, people were living longer, and the planning for those pension funds, how long would people draw against them, the math wasn't done correctly. People were living longer, which means the pension funds had to last longer. And long story short, they were underfunded. So most companies uh, in the 1980s began to switch from offering pensions to offering this other solution. We'll let you contribute to a tax-free form of investment called a 401k. And people began putting money in. Many companies matched it. And so people created their own bucket of money to support retirement. And that was good, but uh, our goal today is to go back and recreate what we had before, recreate that state of mind, that peace of mind of Camelot. And so here's a simple question. When you're working, usually you feel pretty good about your lifestyle because you have what? A paycheck coming in every week or every 2 weeks. But when you retire, that income stops. And most of us, as we enter into retirement, we have two assets, a home and a retirement account, a 401k or a 403b or an IRA. And that money has to get us home. Well, here's my simple question to all of our clients. If you have enough income in retirement to cover your expenses, do you really care what the stock market does on a day to day basis? If you're not tapping your stock investments, you really don't care if they're up, they're down. You want them to be up, but it really doesn't matter. What about interest rates? Well, if you've got enough income coming in to match your lifestyle expenses, who cares what the Fed's doing? They raise interest rates, they drop interest rates. You're kind of insulated from that. And so our model in building retirement plans for our clients is to build a plan that's based on enough income so that you don't worry about your retirement. And I kind of think of retirement as like a house. You think about a house, what is the most important feature of a good home? It's foundation. If you don't have a good foundation, the home is at risk. And so when Tara and I think about retirement planning and when we build 20 and 30-year retirement plans for our clients, we're looking at guaranteed income as the foundation for a safe, secure retirement. Or said another way, what if you don't have enough guaranteed income? It's kind of like a house without a foundation. You hope the market goes up, you hope interest rates do well, but your retirement is at risk because what's underneath it is not solid and sustainable. So, Tara and I, about 10 or 11 or 12 years ago, when we were building financial models, we started to notice something. And that was that people that had more guaranteed income built into their plans had better financial and emotional outcomes. And we saw this over and over again. And so as we built our practice, we would help our clients take a portion of their savings, convert it into lifetime income that increases, keep up with inflation. And we found that our clients had much, much better financial and emotional outcomes. But, when I was starting to write my book back during the pandemic in 2020, I put a chapter in called The Power of Income. And I knew that our models showed that people with more income have better outcomes, but I wondered if anybody else had seen this trend because this is a newer way of looking at retirement planning in the last 10 years. And we came upon a project, a study that was done. It was funded by the Principal Financial Group. You've probably heard about them, big financial institution. The Principal Financial Group hired two PhDs from the American College, Michael Finke and Wade Pfau, and they gave them a bunch of money and they had no control over what the results of their analysis would be. But they asked a simple question. They said, "How does income impact retirement? How does it affect financial outcomes, and how does it affect the emotional confidence or peace of mind that people have in retirement?" And so these two PhDs did 10,000 Monte Carlo simulations, analyzing many, many outcomes with more or less income. And their findings didn't surprise me. They wrote up a research paper. I'm happy to send you a copy if you'd like to read it. It had two principal findings. The first was that people that have more guaranteed income in retirement have improved or better financial outcomes. And I'm going to show you some case studies later in the webinar today, just how much money we're talking about. The second part of their study, they spent half of it talking about the emotional impact. And what they found was that people that had more guaranteed income had better confidence in retirement that they could spend and not worry or stress out that they would run out of money in retirement. Many people that come to see us go, "Bill, the thing I worry about most is outliving my money. What do I do then? Do I greet at Walmart? What do I do?" And so we wanted to take the emotional issue off the table as well, where people could confidently spend and know that they could leave money to their kids and have a legacy. So this was the findings of the Principal Financial Group, and I included it in my book. If you read the book, you'll see the chapter on the power of income talks about what these gentlemen found and why it's important to most of us in retirement. So what do Tara and I do? We actually use a very, very simple three-step process in helping clients build retirement plans. Now, we have some very powerful software that analyzes this, but it really boils down to three things. You calculate your lifestyle budget in retirement. How much money do you need to live on comfortably, to maintain a comfortable standard of living? We index that number and the components that make it up by different inflation factors. Some things are rising in cost faster than others. Medical coverage going up more, pharmaceuticals going up more. Other things don't go up as much. Uh, if you have property, a homestead, and you're in it and you get past 65, you get a senior exemption on your homestead. So your property taxes should be frozen. So some things in our lifestyle budget go up, some don't, some go up faster than others. Well, our models compute all of that. And then the second step is we want to maximize Social Security income. It's an important component. Earlier in this webinar series, we did a webinar totally focused on maximizing Social Security. And I'll touch on it briefly today, but based on the decisions and choices you make, you can maximize your lifetime payout. Well, once we do that, we subtract that from the budget, and usually people have a shortfall. And so our next step is, what if we take a part of your savings and create income to cover that shortfall? Once again, that income has to increase over time also because we know our lifestyle budget's going to go up. So this is a very simple three-step process. The software we have and use to show you where you'll be 10, 15, 20, 30 years out is very complex, but it shows you the path you're on. It summarizes all of this. So let's talk about maximizing Social Security. Most of us, if you've researched Social Security, you know there's three time periods you can claim it. You can claim it as early as age 62. And if you do, you get a reduced benefit because you're claiming early. You can also claim at your full retirement age. And for most of us, that's somewhere between 66 and 67. And the third time you can claim is as late as age 70. Well, what's the advantage to waiting till age 70? Every year past full retirement, your benefit goes up a guaranteed 8%, compounds 8% a year. So if I claim at 67, I get my benefit. If I wait till age 70, I'm starting, let's see, 3 times 8, that's 24. 3/8 are 24. I'm starting with a benefit that's 24% higher. Now, Social Security is indexed for inflation. So when you start with a bigger number, and you index it for last year, it was what, 5.9%? We got a bump. You take a small number and multiply 1.059 or a bigger number times 1.059, you'll find the bigger number grows faster. It gets bigger. And that's what this chart summarizes. If you claim at 62, um, I was showing here, I think it was a benefit of $2,000 a month. So claim at 62, you don't get the 2000, you get a reduced benefit because you're claiming early. You claim at 67, you get your full amount. You wait till 70, you start with a bigger amount. And what you'll notice is very interesting. The lines cross just about age 78, 79. What that tells me is people that wait get more money over their lifetime if they delay claiming benefits. And the amount that you get can be very substantial. So let's take a look at a couple of examples. Uh, we've got Susan. Susan's a 62-year-old single lady. Her benefit at full retirement age is projected to be 2,500. So we ran three different scenarios for Susan. Claim at 62, she gets more months or more years of benefit, but she starts with a smaller amount. Claim at 67 or full retirement age, or wait till 70 and claim. And here's what the model shows us. If Susan has the wherewithal to delay claiming, if she can live off of other savings, she allows her benefit to grow. And it's a substantial difference. Uh, our model here shows what her cumulative benefits would be at various ages, at age 70, 75, 80, 90, 85, 90. Well, look at the difference between claiming at 62, claiming at age 70. By waiting, she gets an extra $309,000. That's a lot of money. Most of us could use an extra $309,000 in retirement. What about a couple? Well, here's another example. Roy and Jill, they were both 64. Roy's benefit was the bigger of the two. He was projected to get 2790 at full retirement age. And Jill was more of a stay-at-home mom. Her benefit was going to be $762 a month. But once again, we ran three scenarios. Said, what if you claim at 64? What if you wait till both you're age 66? Or the third scenario, what if Jill claims at 66, but Roy is able to wait till age 70 and letting his larger benefit grow? The other thing we factored in was we kind of expect Jill's going to outlive Roy. He's not in the best of health. We assume he's going to live to age 85. And when he dies, Jill steps up to that higher survivorship benefit. So, how does this change the numbers? Once again, if they claimed at 64, uh, by age 90, Jill's now 90, they've received a total of 1.2 million, 1.241 million. But if Roy is able to wait till age 70 to claim, his benefit is much bigger and it continues to grow and expand with inflation. The end result, here again, we've got a differential of 272,000. So making a smart, informed Social Security claiming choice is the first step in building an income base for retirement. I'll say one more thing on Social Security. We know that it's underfunded. And we also know that Congress needs to act by, they think, 2031 in order to keep the program solvent. And I have every reason to believe Congress will act. If they don't, benefits are going to be cut. And so my question would be, would you rather have a big number reduced by, say, 20% or a small number reduced by 20%? I'd rather have the big number. In either case, whether Congress acts or doesn't act, we're better off to maximize our Social Security benefit. Okay, the second place, many of our clients, after we've built the budget, maximized Social Security, we find that there's a shortfall. They don't have enough income to support their lifestyle, and they're hoping the markets are going to go up. They hope. Everybody hopes. And what do most people have as they enter into retirement? A home that's valuable. A couple of weeks ago, we talked about ways to tap home equity. You may want to go back and listen to that webinar. But today, I want to just focus on one other area, and that's using a portion of our retirement accounts, IRAs, 401ks, 403bs, to generate more income. And how do these accounts work? Well, we fund them while we're working. Hopefully, our employer adds to it. The money grows tax free. But under current laws, when we turn 72, we have to start taking required minimum distributions. We have to start taking a percentage of our account value out. And that percentage starts at around 3.6% at age 72 and goes up. The percentage gets bigger every year as we get older. If you make it to 115, most of us won't, but if you make it to 115, you got to take 50% out every year. Well, what do Tara and I do? We look at ways to use a portion of an IRA to satisfy the RMD. You got to take it anyway, but we satisfy it adding a tool on to an investment that creates guaranteed lifetime income. The income stream we create increases if the market's up. So it's like Social Security. It's trying to keep up with inflation. And we're going to show you a model where the goal is eventually to convert the income stream to future tax-free income. Remember, when you take money out of an IRA, what do we have to do? We have to give Uncle Sam a percentage. Well, I'm going to show you a way to convert that income into tax-free income. So here's a simple model. We've got an IRA. On the left side, we've got the IRA. On the right side, we've got the same amount. And we're going to break it. In this case, I show it being broken into 50-50 chunks. There's no magic to that. It could be 60-40, it could be 70-30. But what happens when we turn 72? Well, on the left side, we have to start doing those RMDs, those required distributions. And I call that annual dipping. This is what a lot of people do. They take out the appropriate amount and pay tax on it, and they can, and save the money, they can spend the money, but they start doing annual dipping. On the right side, Tara and I divide the IRA into two chunks. And once again, I'm showing it 50-50, but there's no magic to this. And we put half the money in this case into a product, a tax-deferred annuity that has a feature that when I turn it on generates a lifetime income stream. If you're married, this lifetime income stream pays out whether either of you are alive, whether either spouse is alive. So, ladies, since you tend to outlive us guys, this portion of the presentation is for you. You create an income stream that neither of you, especially the ladies, can outlive. Well, what's going to take place over time? Over time, the percentage we have to take out as we age is going to increase. So the amount we're annually taking out is going up. And generally, IRAs will gradually fall in value because you're taking out a larger and larger percentage every year. Well, the same thing's true on the right side. The IRA annuity is going down in value. Now, it's that lifetime income stream is satisfying the RMD amount, and you'll notice the arrow got bigger because if the market's up, the lifetime income stream continues to increase as long as either spouse is alive. Well, let's fast forward a little bit further. And eventually, our annual dippings got even bigger. What happened to that IRA annuity? We drained it. We drained the account. But remember, it's lifetime income. And so the amount that's coming out continues to come out. I call that free money. Over a period of 10, 12, 13 years, the annuity paid out all the money you put in, but the checks keep coming. What? Yeah, the checks keep coming. And meanwhile, that other portion of the IRA that we didn't have to tap as we were drawing down against the annuity, well, it was growing in value. This is kind of like having your cake and eating it too. You've still got the IRA amount on the right side as you do on the left, but and you now have to start taking annual withdrawals out of it. But the 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 benefit is you have a separate pension that's a lifetime increasing pension. But the story gets even better than this. I mean, not only are you getting free money, but what do we do with that IRA annuity just before the bucket goes empty? We go back to the custodian, an insurance company, and say, "Hey, I want to flip my IRA annuity to a Roth IRA annuity." And since there's only a few dollars left in the annuity, the tax consequence is minimal. But what do you get from a Roth IRA that you don't get from a traditional one? Tax-free income. So not only are we getting uh, a lifetime income stream that will pay out, not only are we getting free money, but the income stream, say at age 83, 84, 85, becomes tax-free money. That's like giving yourself a raise in retirement. That feels pretty good to most of our clients. Well, let's look at a case study. And here's an example. We had a couple that came in, Lucy and Bill. They were both 68. We did a budget for Lucy and Bill, and we found that their lifestyle, their monthly spending habits required $6,000 of monthly income. And we factored in an inflation rate of 2.5% on that. So that 6,000 is going up every year. We looked at their Social Security, and Lucy at age 68 decided to claim hers, and she was getting 1856 a month. Bill, on the other hand, decided to wait till age 70, and his benefit would be 3564. Now, that's not enough to cover the $6,000, so we have a shortfall. And I said, "Well, what do you have in savings?" And we just looked at their savings, not their house. And they had about 725,000 in savings. The majority of that, 675, was in Bill's 401k. And we built a model, and we assumed that amount would continue to grow 5% annually in the market. Now, you and I both know there's some years that the market's up better than 5%, and then there's some years where the market tumbles greatly, like in 2000 or 2008. And, we're kind of at this fragile period in our history where the Federal Reserve is stumbling into facing the fact that we've got rampant inflation. First, it was transitory. It was only going to be with us for a year. When COVID kind of diminished, it would go away. But you and I both know that inflation didn't go away. If anything, it's continuing to rise. And if you go to the chapter in my book on inflation, you'll see that something disturbing has been happening for years. Our government's been spending way more than it makes. The amount of our debt, percentage-wise, compared to our gross national product, has been rising. In 2021, for the first time since 1945, our gross national debt as percentage of gross national product exceeded the high water mark at the end of World War II of 120%. In 2021, it got up to 135%. So we know that our government's spending way more than it makes. But what happened in 2008? We had the Great Recession, and the Federal Reserve dropped interest rates to stimulate growth in the economy. But the economy didn't come back. It was the Great Recession. It wouldn't go away. So the Federal Reserve decided to do something new. They started buying government debt. Think about this. The federal government spends more than it makes. It prints bonds to cover the shortfall. And in the past, it sold those bonds to you and me or to governments like the Chinese or other governments. And then in 2008, the Federal Reserve decided to start buying the debt. So one governmental agency spends too much and another one buys it up. Well, how did the Fed pay for it? The Fed has the ability to expand the money supply, to essentially print money. And that's exactly what the Fed did from 2008 to 2021. They printed or expanded the money supply by $8 trillion. And that infusion of liquidity into the market helped the stock market continue to ramble forward. In fact, many people ask me, why did the stock market continue to do well during a global pandemic? Remember, a lot of restaurants closed and the airlines lost millions and billions, and cruise lines shut down, and there were supply chain disruptions, but the market just kept rising. Well, several months ago, I heard an interview, and it was with a very smart guy, and he said, the Federal Reserve, in buying up all that debt, created artificial liquidity in the market. It buoyed the market. It allowed the market to continue to rage forward. And the end result is stock market's gone up, but now the Fed has to fight inflation. They bought up $8 trillion worth of debt at a certain interest rate. Now they're raising interest rates to fight inflation. And when interest rates go up, the value of older bonds that pay less, in this case, government debt, government bonds, is going to drop. So the $8 trillion investment they have is going to plummet. Bottom line, this is an unstable period. The Fed can't buy any more debt, and interest rates are going to have to go up to fight it. I don't know what the markets are going to do, but I think everybody needs to ask that question. So let's see what we can do for Bill and Lucy. We worked out a model with them. We took a portion of their 401k, 275 in this case, and we invested it into one of those income annuities, and that annuity would generate 1107 of monthly income at age 70. The income stream grows if the stock market is up. So let's compare. By the way, we assumed Bill's going to live till age 83. Let's see what happens. Our model shows that at age 100, with all the money invested in the market growing at a consistent 5% rate, Lucy still has $345,000. But what happens when we added the income opportunity? Look what it does. It boosts her money at age 100 up another $241,000. This is the power of income. This is the power of tax-free income when they've drained the account and when Lucy outlives Bill, she continues to draw that lifetime pension, which is increasing, and it expands her net worth, age 100, by $241,000. This is the power of income. This means she can leave a bigger legacy for her kids or grandkids. And that's what a lot of people want to do. So what I've tried to show you with the two case studies, or the case studies we've gone over, maximizing Social Security and adding income to your retirement planning can have a very positive effect on your financial outcome. And like people that are working, can also give you a sense of confidence that you aren't going to outlive your savings and that you're going to have money to leave as a legacy to your kids. So that's kind of what I wanted to cover today. Let's see. Tara, do we have any questions?
Oh, I don't see any just now, but if you are interested in asking a question while we're on live, you can go up to that talk bubble at the top of your screen, click on it, and type in any questions. But like we said before, our consultations are always free. You're welcome to give us a call or shoot us an email, set up an appointment so we can look at your own personal situation and see how we can help. As always, we will send out this webinar in an email so you can re-listen to it, pass it on to a friend, and then in about 48 hours, it'll be up on our website to peruse at any time if you want to come back and listen to it.
And we're going to send everybody a PDF of the book. If you'd like a printed copy, I know a lot of people would prefer to have something they can hold in their hand. Uh, After you get the email from Tara, just bounce back and say, "Hey, I'd like a printed copy." We don't sell the books; we give the books away. Happy to provide them. I think you'll find that they're very educational. They cover a whole range of topics, of issues that you and I are going to run into in retirement. And they talk about creative strategies to make sure your money lasts as long as you do. Next week, we're going to cover a different topic, and that's how people younger than 60 can also, there's another strategy for creating tax free income in retirement beyond what I talked about today. So if you have a son or daughter, neighbor, friend that's under 60, have them tune in next week, and we'll share with everybody a strategy for maximizing their income in retirement. So, with that, Tara, anything else?
No, I think that's it. We'll look forward to seeing everyone next week.
Well, thank you for joining us. Have a good week.